but we're going to talk about special needs planning and taxation. And this is a great way to end because, of course, special needs planning kind of touches on all the different topics we've discussed today. So there'll be some things that Julie and Jenna said touched on special needs planning, but they did not go into greater detail. So I'm going to kind of tie all that together, and we will be able to wrap it all up and show how it all works in practice. All right, and so what I'm going to during this presentation, I'm going to cover just generally at the beginning, what is special needs planning and how is that differentiated from general estate planning. Then we're going to talk about some funding vehicles, trust, ABLE accounts, the different devices that are out there for special needs planning. And then we're going to talk about the taxation of it all. As tax professionals, how do you do this? All right, well, first, let's talk about me. My name is Landon Hodges. I'm one of the third partner at the firm, the only one you've not heard from today. If you pick up an accent, all the accents from North Carolina, all of my education was done down there. I've been working with the firm since January 2017 and became a partner in 2021. And it's been a busy year for me. I recently became a father. So the picture up there is my wife, Emily, and my daughter, Eve. She was born in March. And so I'm not too sleep deprived yet and still coming along just fine. All right, so let's dive right into it. What is special needs planning? So this is legal planning or estate planning for a minor or adult child that has special needs. So, so what makes the needs special? Of course, they might be receiving government benefits. They already receive or are likely to receive them in the future, or you know that they'll need high medical expenses or intense care. So this could be somebody with a disability that was born with a disability or acquired one later through an injury, where you know that their needs are going to be more than your typical beneficiary. So why is this important? Well, a lot of times we're dealing with government benefits, such as specifically SSI and Medicaid. And those benefits have means tested eligibility. So in order to maintain those benefits, a person needs to have their assets below a certain amount. So for most people, this is very relevant, because even if you plan to leave a good amount of money to a person with special needs, these asset thresholds are very low. So one of the examples we're going to go through today is think about a beneficiary or a well-intentioned grandmother that leaves $20,000 to each of her grandchildren. Well, that's a good amount of money, and I'm sure that can go a long way for a lot of people. But that amount of money is enough to kick a person off of their benefits altogether. So if we talk about a child that has intense medical needs, $20,000 can get rid of all of their benefits, but is by no means lifetime money. So we're going to talk about strategies to plan for that person to ensure that they can be as independent as possible, but still be entitled to any benefits that they would otherwise be eligible for. All right, so what tools do we use to do that? Well, it starts with, of course, empowerment and planning for decision-making through powers of attorney and guardianship. Of course, wills come into play, trust, summary of our wishes, beneficiary designations. We'll go through those kind of one by one as we go along. Let's start with the foundation of it all, probably the most important estate planning document. Now, of course, Julie talked about kind of what powers of attorney are, but this is with special needs planning. When I'm meeting with a client, the first thing I'm looking at is if the person's over 18, can they sign a power of attorney? Because this allows for a person to name another person to be their agent to make financial and medical decisions on their behalf. In order to do that, they have to have the capacity to understand what they're signing. Now, that doesn't mean that they, have to be able to read the whole legal document and pass a quiz on it, but they generally need to understand that they are signing a document giving healthcare and decision-making powers to another person, generally what's meant by that, and be able to identify who they would want to be in that role. Pennsylvania prefers this because I'm going to talk about guardianships in a second. Guardianships are a much more restrictive right that comes with a loss of liberty for the person under a guardianship. Whereas a power of attorney doesn't give away any power that the person with special needs would otherwise have had. It just chooses a person that would share it. So most commonly, let's think of a special needs planning scenario where a child just turned 18 years old. Well, the parent knows that something needs to be done. A lot of times the school system might mention guardianships, but if that person can generally understand a power of attorney, they can name their parents as their agent and then continue with all the powers that they had prior to that person turning 18. But now, for people who can live somewhat independently and need some help, powers of attorney are great. But what about a situation where a person is completely unable to understand a power of attorney enough to sign them, or could be victim of scams or designing persons, such that the freedom of still being able to make their decisions could be destructive? Well, that's where we go into guardianship. So that's the other way that the decision-making authority can be obtained over a person with some level of mental incapacity. So under a guardianship, you still get the same power to make financial and medical decisions, but you have to go through a judicial proceeding, and a court appoints a person to make these financial decisions. And this comes with a declaration of incapacity. So as a matter of public record, the person under a guardianship has been deemed incapacitated, meaning that their signature does not work. They are not allowed to sign legal documents. All decisions must be made by the guardian. Now, when differentiating whether you're going to use a power of attorney or a guardianship, one of the things that I have to counsel clients with all the time is that making bad decisions is not the same as being unable to make decisions, especially if we're dealing with people who just turned 18. If making bad decisions alone could put you under a guardianship, I don't think there would be any teenagers that aren't under guardianships, because they're not known for being the best decision makers. So that's one thing to take into account there. But in order to do this, we have to have medical testimony that this person is unable to make and effectively communicate decisions at all. So those happen, with a person that turns 18 that was disabled from birth and really has never had the ability to make these decisions. But this process can take up to 3 or 4 months and is much more costly than getting POAs in place. So anytime you're working with a family that has a beneficiary or a child with special needs, make sure that they're carefully counseled on the options that are available for them to make sure that we don't do unnecessary guardianships. All right, so that's the background of decision-making authority. We want to make sure that anybody who needs assistance can get it. But let's talk about what is more pertinent to the planning side of this, which is what happens if a person with special needs receives some sort of windfall payment, whether that's an inheritance, a settlement from an accident, a large gift, whatever it might be. Let's address a situation where a person with special needs receives a large sum of money. I'm not going to put a dollar amount on that. Large it differs family to family. But so this could be, any sort of assets by will, life insurance, gift, IRA that had the person named as a beneficiary. One of the examples is win big at the casino. Well, I guess, it happens, whatever it might be. That I mentioned earlier, that person could lose their benefits, and SSI and Medicaid are the ones that you're going to see most commonly on here, because one, they are the most common, and two, SSI is very strongly means tested, and that the person that's receiving SSI cannot have more than $2,000 in their name, total assets. So I used a $20,000 example earlier. A $5,000 gift or inheritance could throw a person off SSI and lose their income entirely. So that's why we want to keep an eye on this. So what are our options? Well, we could use a special needs trust, an ABLE account, or just spend the money down. I mean, once you receive money, you have a month to spend it. Now that's great. If you're $500 over, sure, you can figure out a way to spend $500 because you're allowed to spend the money on anything that's for the person with special needs. Of course, you can't gift it, but you can spend, does the person need new shoes? Do they have old electronics or really whatever do they need. Now, spending it down works for a few $100, but when we get into a few thousand or several $1,000s, we need to get a little bit more creative because we do want to save this money. We do want this money to be for the benefit of that person for as long as possible. So let's go into these kind of one by one, starting with the special needs trust. So the general purpose of a special needs trust is to supplement but not supplant any benefits that the person might already be receiving. So, and that's all. In any special needs trust will have that language in it because, again, that money is there for this person, but so should the benefits, and the trust is there kind of as a background to cover what the benefits don't already cover. But public benefits should be the payer of first resort. Money in special needs trust, as a general matter, should not be used to purchase food or shelter for the person, especially if the beneficiary is receiving SSI benefits, which I keep using that acronym. That's Supplemental Security Income through the Social Security Administration. But I'm going to stop on that point for a second because anytime you're working with a family that has a member with special needs, unless they are very well educated on all the different benefits that are out there, they'll just say, well, I don't know what the income is. They get Social Security. Well, unfortunately, it's a little bit more nuanced than that because SSI is different than Social Security Disability, or SSDI, so Social Security Disability Income, which is not means tested. So, okay, yeah, oh, they get Social Security. Yeah, the check comes from the Social Security Administration, but which one is it? Because it matters a lot when you're planning for this person. So the reason that the trust should not be paying food or shelter for this person is that if a person receives SSI, then the purpose of the SSI payment is to cover necessities. It's not a large amount of income. The maximum that a person is allowed to receive in 2023 is under $1,000 a month. But one of the central purposes of it is to cover necessities, most commonly food and shelter. If Social Security Administration finds out that a person is receiving necessities or food and shelter from another source, be it a parent, meaning a person's living in their parents' house rent free, or there's a trust paying for their rent or their food, then that's what the Social Security Administration would call in-kind support and maintenance, or ISM. You'll notice in this area of law that it's just very acronym heavy. So pop in with questions if I use one that I don't explain, but in this situation, it would be in-kind support and maintenance. And if that's happening, they get a 1/3 reduction in the benefits that they would receive. So which that could be a difference of multiple $100s a month. So the trust should not be paying for shelter or food. And in a situation where a trust owns the house that the beneficiary is living in, that beneficiary should still be paying room and board to the trustee. So that way, one, you're increasing the trust assets with that money and keeping it there for the beneficiary. But two, the reduction in benefits does not happen, and the money that they're paying for rent can still go for their benefit in the future. So be careful about the language of that. Now, when I write a special needs trust, one, I call them a supplemental needs trust. If you ever see those differing terms, it means the exact same thing. It's just softer language in my opinion. But special needs trust, supplemental needs trust do the exact same thing. They exist for the same purpose. But when I write them, I make it discretionary to the trustee. Money may be used for food and shelter, but that's in the trustee's discretion. And if I were advising that trustee, I would say, well, if they're receiving SSI, then no, you're not paying food and shelter. But if they're not, if they're just on SSDI, that's disability income through either the disabled person's work record or through the work record of a deceased or retired parent, then sure, the trust can pay food and shelter expenses. So it's all about what benefits is the person actually receiving. And so Julie talked a little bit about trust under will or testamentary trust versus standalone trust. It's very important that a trust for the benefit of a parent's child be set up before they pass away, because you don't want the money to ever touch the disabled person's hands. Because as I'm going to illustrate here in a second, there's different types of trust here that could be used to plan for this person. If a parent establishes a trust for the benefit of their child, that's what's known as a third-party special needs trust, which is going to be on my next slide. That trust does not have to get paid back to the state when the beneficiary dies. But if the money ever touches a disabled person's hands and then they have to do something with it, there could be potential payback options depending on the method used. So when I'm talking to a family, usually it is an older person or an adult that has a child with special needs. We're setting up a third-party special needs trust. So what makes it a third-party trust? Well, it's funded by someone else's money other than the beneficiary. Parent, that well-intentioned grandparent that wants to give a $20,000 gift to their grandchildren, a sibling, whoever it might be. It's less restrictive, and again, there's no payback provision. So what does that mean? Medicaid is the most common way for anybody who needs long-term care to pay for those services. And whenever Medicaid is paying for nursing home or in-home care, they're keeping a ledger. Every time they make a payment, it's being tracked. And when the person that's receiving Medicaid dies, they bill their estate for every dime they ever paid on their behalf. So let's say a person was in a nursing home for a year before they died and Medicaid paid $90,000. That person's estate is getting a $90,000 bill. Now that's the probate estate. And if there's nothing in that probate estate, then that bill goes away. A third-party supplemental needs trust is not part of that estate. So if a parent set it up correctly, then that money was there for their child's entire life. If that child ever needed long-term care when they got older, they can qualify for Medicaid benefits. Then when that child dies, the residue beneficiaries that the parents name receive all of that money, not subject to a Medicaid payback. Very important that this gets set up well ahead of time, because once the money touches the disabled person's hands, this option is no longer on the table. And these trusts can be revocable or irrevocable, depending on the situation. But I usually start mine to be revocable so that the parents have some flexibility in changing it as their estate planning goals change. All right, so let's use the example of Paul here. So Paul's 30 years old, has a bipolar diagnosis. He's unable to hold a job, lives in subsidized housing. So he receives SSI and Medicaid. So he's disabled. By receiving SSI, you know that he's disabled as defined by Social Security Administration. Paul's mom wants to leave him an inheritance. So how can he do it? Well, as we discussed, she could just do it the classic way, put Paul in her will and name Paul as the direct beneficiary of all of her IRA, life insurance, whatever. She dies, everything goes directly to Paul. All of his benefits, his SSI, his Medicaid, everything's in jeopardy at that moment. But what she could do, set up a third-party trust and then put anywhere that she would name Paul in her estate plan, she should name that trust. So this is another reason that, as Julie mentioned earlier, a living trust or a standalone trust is preferable to a trust under a will, because not only can it be named as the beneficiary of your will, but it can also be named as the beneficiary of your IRAs, pertinent to what Jenna was talking about, and your life insurance policies, your transfer on death accounts, whatever you got out there, you can replace Paul's name with this trust. And as I'll discuss later, under the Secure Act, as long as the trust is done correctly, the trust will be a qualified eligible beneficiary of the IRAs, which will allow you to stretch the RMDs across Paul's entire life expectancy. So this is one of those strategies where you can use your IRA to lower the tax benefit of the Secure Act on the 10-year versus lifetime stretch, and make sure that that money is there for Paul without jeopardizing his benefits. So if Paul's mom came to see us, we're going to have Paul set up in that situation. Now, let's talk about a situation where Paul's mom didn't do that, and now mom passes away, Paul receives everything. I guess in this example, let's just assume Paul's an only child. So now all this money is in Paul's name, and he has to do something with it, or else he's going to lose his benefits. So Paul himself, or his guardian or power of attorney, if he's not able to, would execute a first-party special needs trust on his behalf. Now, the function of the trust is the exact same as a third party. You still have a trustee that manages all the assets. It's there to supplement but not supplant benefits. Paul's the sole beneficiary, and it's there for whatever he needs, in addition to his benefits. But the big difference is that it has that Medicaid payback provision. So under my example, where Paul needs nursing home care now, and Medicaid pays $90,000 on his behalf over the span of his life, Paul dies, Medicaid bills his estate $90,000. Every dime in this first party trust is liable to be paid back to the state for that. So the residue beneficiaries in this case are only getting what's left after Paul's Medicaid recovery lien is paid, as opposed to the other example where you would have 100% of the assets of the trust payable to the beneficiary. Also, a first party special needs trust cannot be funded after the beneficiary turns 65. So if we're talking about older people that are already applying for Medicaid benefits for long-term care, they can't just dump money into a supplemental needs trust. They're going to have to look at other funding mechanisms. The question is, which special needs trust is funded using the beneficiary's own money? We're looking at first party or third party. First party trust is the one that uses the beneficiary's own money. And that's important because I'm dealing with a case right now that an attorney was confident enough to do a trust but didn't know this part, and that person now owes Social Security every dime they paid to him over the course of the 4 years that this trust was in place. So proper planning is very important here, and I'm just having to deal with the Social Security mess. We don't want to do that. All right, let's look at another example here. So this one's Jamie. Jamie's 15 years old with minimal verbal responses, and developmentally is 3. Jamie had to live in a residential facility, but from birth, Jamie's father had been saving money in her name. So she's got $30,000 in her account. So what are the issues with this? Well, after Jamie turns 18, if he's going to be looking for any sort of benefits for his income, because in this situation, Jamie's not able to work and living in a residential environment, Jamie's going to have to apply for SSI. But he can't have more than $2,000 in his name without jeopardizing benefits. And so what we could do is set up a first-party special needs trust for Jamie and then transfer that $30,000 into the trust. All right. Now, the trust I've been talking about, the first versus third party, are special needs trusts that would be set up as part of an estate plan through an attorney, whether by the parents or by the disabled person themselves. For smaller amounts of money, or if there's not enough funds to go into the trust to justify the investment of setting it all up, there are what's called pooled trusts. These are usually ran by banks like Achieva Family Trust out of Pittsburgh. I believe there's one, Secured Futures, that is administered by a nonprofit, and it's as it sounds, it's pooled. So you put money into the trust for the benefit of a beneficiary. So in that way, it works the exact same. But for investment purposes, all of the money is pooled for investment management purposes. And it's good for smaller trust accounts because it's much cheaper to set up. But again, it does have that payback provision at the end of the beneficiary's life. So for that middle ground where, yes, somebody needs to do something, but not enough to justify a full plan around a standalone trust, pooled trusts are an option. All right, so let's now, Jenna did a great overview of Secure Act and Secure Act 2.0, but specifically in the world of special needs planning. I mentioned earlier that if you name a special needs trust as the beneficiary of an IRA, it can be a eligible designated beneficiary, EDB, and qualify for the lifetime stretch of the beneficiary. There was always a question on the Secure Act 2.0 I guess Secure Act 1.0 as to do we have to look at the remainder beneficiaries of the special needs trust? And under Secure Act 2.0, that's clarified that a charitable organization can be a remainder beneficiary of the trust, and the trust still qualify as an EDB. So again, this is a good way to get that lifetime stretch if a family has a beneficiary that has special needs. All right, so let's talk about another option we have. So we talked about trust, both first party, third party, and pooled. Another option is what's known as an ABLE account. So this is a savings account specifically for people with disabilities. And under the current law, they must have been disabled on or before age 26. Note that we've already passed legislation to raise this age to 46. That's not going to be effective for a few years. So right now, still disabled on or before age 26. So a person that is able to do it can set up their own ABLE account, but it can also be established for by a parent, guardian, power of attorney, on behalf of another person. One thing that's important about this is that anybody can add money to the account, but there are annual maximums, and each beneficiary can only have one account in his name. So, easy example, we've got a situation with divorced parents. They can't each create an ABLE account for their child. They have to create one and contribute to the same one. But notice that it's at the very bottom of the slide there. It says that a PA taxpayer can only deduct contributions up to $17,000. But also, it's important to note that from all sources, you can only contribute a maximum of $17,000 per year per beneficiary. So mom and dad can't each put $17,000 in there. $17,000 total. And ABLE account does have Medicaid payback provision, but again, PA may or may not claim on that. That's a little bit more loosely defined than the trust side of that is. So be wary of that. But this is great for smaller amounts of money. Looking at less than $17,000. Oh, okay, I got ahead of myself, but so yeah, $17,000 per year is the limit. That awful acronym I've got there, that's the Tax Cuts and Jobs Act 2017. That allowed for a 529 plan to be rolled over into an ABLE account. So from a tax perspective, these two accounts work very similarly, but of course a 529 plan is for college and education savings. ABLE account is for disability related expenses. So good example of how this works out in planning in the real world is child is born, you start saving early, you open your 529 plan. Turns out that child has severe disabilities and very, very unlikely to go to college. Well, that 529 plan can be rolled over into an ABLE account and be administered that way, but watch out for your annual limit. Now that $17,000 number is tied to the federal gift tax exclusion limit. So as I was updating this for the year, 15 when it was created, 16, now 17, I believe going up to 18 next year. Let's see here. Now there are overall account limits. If a person's on SSI, they cannot have more than $100,000 in an ABLE account. But I mentioned earlier the importance of knowing what benefits a person's on, because if they're not on SSI, such as they're just on SSDI, again, that disability, then they can have over $500,000 in that account. So that's very important to know. If a person does it in this SSI scenario where you have more than $100,000 in the account. Anything over $100,000 is a countable resource, which, as we mentioned earlier, that person cannot have more than $2,000 of countable resources in their name. So you've got a tight window to play with there. So disbursements from the ABLE account, similar to trust, that money is there for the beneficiary's, quote, disability-related expenses. What does that mean? Well, what does that not mean? I mean, you're not gifting it to somebody else, but if the person needs it, then it can be paid. Now, an ABLE account can also pay housing expenses, even for a person on SSI. This is one of those things that no one asked me to make this consistent, but what's the difference, or why is that difference? I don't know. That's what the law says. So, for example, a SSI can fund an ABLE account. So a SNT, a supplemental needs trust, can fund an ABLE account. So you've got a beneficiary that has SSI that needs help with rent. Well, the trust funds the ABLE account, funds the housing. I didn't write the rules, so there's that. So under the Tax Cuts and Jobs Act, ABLE account owners who are able to work and make some income may contribute additional funds up to the federal poverty level for a one-person household. I put the 2023 number in there for you. I don't think I had the 2024 number, but $14,580, or their gross wages. So it's capped at the $14,580, but all of their gross wages can also go in there if needed. And then if they're already contributing to some sort of annuity contract, compensation plan, or a employer-sponsored retirement plan, that might be capped. But note that there is somewhat of an exception to that $17,000 maximum. But if you have a parent that's contributing to it for a disabled beneficiary, be careful with that $17,000 max. So as with any sort of fiduciary account, got to keep records, make sure that your limit's not exceeded, and that you're not making any distributions that would make the Social Security Administration angry. And let's see here. In order to do that Tax Cuts and Jobs Act exception to the $17,000, there's a work self-certification form through the ABLE website, which all of this, it wasn't at the beginning. ABLE accounts are not legal documents that are set up through an attorney's office like trusts are. All of this can be done online by, again, the beneficiary themselves, parent, guardian, power of attorney. It's paable.gov. And all the tools and resources that you would need are on there. In order to report distributions from ABLE accounts, you got Form 1099 QA. And then contributions to an ABLE account, Form 5498 QA. And deductibility of ABLE accounts are very much like 529 plans. So let's talk about transferring one. So you've already got one set up for the benefit of one beneficiary, and we want to transfer it to another one. It can be done to a sibling of the old beneficiary if it's a sibling, and of course that person has a disability that qualifies them to be an eligible individual. So of course you can't transfer an ABLE account to a non-disabled person, but no tax consequence can be added to the new beneficiary. If you transfer it and the person's not a sibling or is not disabled, that's a non-qualified withdrawal, which would be we've got taxes on the earnings, but then also a 10% penalty on that. So only in rare circumstances are you going to see one of these being transferred. So let's talk about taxes. That's why we're all here, but I want to make sure that everyone's aware of these resources that are available. So the deductibility I mentioned earlier can be deducted on their Pennsylvania return for up to $17,000 per year. And then just like a 529 plan, the investment earnings within the ABLE account are untaxed until the money's taken out. And then when I use the term qualified disability expenses. That's, again, there's some examples here. So the slam dunk, the obvious ones: medical treatment, education, transportation, assistive technology, housing, and legal and administrative fees for this type of planning. But the rule of thumb is think about needs. As long as you've got some sort of non-laughable argument that these expenses are for the benefit of the beneficiary, then you're probably in good shape. And if all else fails, you could always run a question by your attorney or by the Social Security, whoever's paying the benefits, whether that's Social Security or Department of Human Services, to make sure that a particular distribution is not going to have any sort of adverse effect. So continuing with the tax benefits there, there's retirement savings contribution credit for people who are over 18, not a student, and not claimed as a dependent. And then this can be taken by the person that's the eligible beneficiary. So let's talk about that example where a person is able to work and they're able to put their W-2 wages into this ABLE account. Then that contribution also has a retirement savings credit, but not rollover contributions. So ones that came from the 529 plan don't count, but this would be for the beneficiary who's contributing to their own ABLE account. In the estate planning context, where these are used most commonly, is I talked earlier about the well-intentioned grandmother that gives $20,000 to each of her grandchildren. That's a little bit over the limit. I mean, again, you could get it close, but let's say that number was 10,000. Well, at 10,000 bucks, it's not going to justify, that alone would not justify setting up a first party trust and all of that. But $10,000, you could open up an ABLE account, put all $10,000 in. As long as that's done within the month of the receipt, then you've satisfied the spend down, you've kept the beneficiary under $2,000 total, and that $10,000 has been preserved for whatever expenses that person might need in the future. So with these tools in place, so again, we've talked about first party trust, third party trust, pooled trust, ABLE accounts. How do you choose between them? So I've talked about, dollar amounts come into play quite a bit. Also look at management fees. ABLE accounts are a lot easier to manage. You don't have to have a third party trustee involved. And consequently, the fees are cheaper to manage them. But also look at the contributions to each. So that's usually the biggest one. ABLE accounts have that $17,000 per year maximum, and that contribution must be cash. So your investment options within an ABLE account are lesser than maybe a trust would be, whereas a trust can be funded with any asset. So if there's a non-qualified brokerage account or an inheritance paying straight to a trust, or either from a will or through a life insurance policy or a retirement account with a beneficiary designation, all of that can go into a special needs trust. And in the special needs trust, the trustee has much broader investment authority, which makes it a lot more preferable if we're dealing with large sums of money. So I think management fees play a role in this, but I think the biggest contributing factor to this decision is really how much are we planning around. If it's a smaller amount of money, especially in that $17,000 range, ABLE accounts are going to be much easier and cost effective to establish and maintain. But for a large amount of money or for a parent's inheritance, special needs trusts are usually going to be the way to go. But also look at that Medicaid payback. So again, that still kind of goes back to the amount of money, but if we're talking a large sum of money that might outlast the beneficiary's life, a third-party special needs trust is the gold standard because you don't have that Medicaid payback. But between an ABLE account and a first-party special needs trust, ABLE account has payback language, but it's less, it's more loosely defined and may or may not be claimed, whereas a first-party special needs trust has a very strict Medicaid payback. It's written straight into the trust, and that will be claimed. So always be aware of that. Larger sums of money, of course. And also remember, I said earlier how they could play together. So if you like some benefits of an ABLE account, such as the ability to fund housing expenses and whatnot, you can have both. You just can only have one ABLE account, but a trust, if the terms of the trust allow, can pay over into it. And then, of course, there's the tax benefits to an ABLE account, where you've got the tax-free growth until the assets are used. And there's the tax deduction for contributing to it as well. So that a lot to play in there, but still, I'm still going to go back to the biggest contributing factor is how much are we dealing with here. So I gave some examples of what cannot be done for a special needs trust. So what can it pay for? Well, medical expenses, obviously that is a need. Under the Tax Cuts and Jobs Act, the medical expense deduction is still there, but subject to 10% of AGI. So to the extent we have these extreme medical costs, then you've got this trust that's there for this particular purpose. It can be used to pay for any special equipment. So under these benefits, you know, wheelchairs and some equipment might be covered by the benefits. But then what about a handicap accessible van? That's an example that I put in here because I've actually dealt with this exact situation where we had a very strict special needs trust that was set up through an insurance settlement that had language in it that required a court approval for any expenses over, I believe it was $20,000. But of course, you know, we're setting these things up to ensure as much quality of life as possible for the beneficiary. So if that person has significant healthcare needs, then or transportation needs, a handicap accessible van, if there's enough money there, and you know, from the viewpoint of making this money last that person's life, this is absolutely a permissible standard, and the court had no problem approving that. But travel expenses. So this is an interesting update from, I believe it was the 2018 Social Security regulation updates. Travel expenses. So when I say this is there for the person with special needs, you know, their disability related expenses, or, you know, whatever they need, you know, to supplement but not supplant their benefits. Well, travel expenses, whether it's to see family or to even go on a vacation, is necessary for their need because, of course, mental health is health. And also the next one there, travel expenses for a third party, are also justifiable expenses. And that's because, well, if a person has severe needs with their activities of daily living or transportation needs, they could not be able to go visit family or ride on a plane or go on vacation without their caregiver. So if we're talking about any sort of necessary travel, or again, even a trip within reason, even the travel expenses for not only the beneficiary, but the beneficiary's caregiver could also be included. So that's important to note. So vacations on there, recreation, entertainment, training, or education. Again, this is a pretty broad standard because we are trusting the trustee and their discretion to make sure that the beneficiary's needs are provided for over and above what the benefits that they're receiving can pay for. So even though there are some strings attached to a special needs trust, it's important to know that the standards are still pretty broad. They are irrevocable, you know, after the person that set it up dies. Even if it was irrevocable when the grantor was alive, it's going to become irrevocable when that person dies. So in terms of who's the beneficiary and what happens when that person dies, all of that is locked in. But the trustee can have pretty broad leeway to ensure that a person's needs can be met. Can a special needs trust be funded with a life insurance policy? True or false? And again, majority rules, so that is true. An SMT can be funded with a life insurance policy. As I mentioned earlier, the way I would always recommend doing this is to have the trust set as the beneficiary in the life insurance policy, so that way, upon the death of the insured person, money pays straight into the trust. But the trust can also be named as a beneficiary in the decedent's will. So that way, if they don't have any beneficiaries named, life insurance money goes into the estate, then pays out to the trust that way. Either way, you're getting cash in there. And that is a great planning technique for persons with special needs, because that, on an inheritance tax point of view as well, life insurance proceeds are not taxable. So we're getting tax-free cash into the trust for the benefit of this person, hopefully for the rest of their lives. This is a situation from on a point for planning here. When I'm working with families that are worried about how long their assets could stretch for the benefit of their disabled child, life insurance is a great way to fund these things, because again, you get a lump sum of cash. And in the area that we all practice, I'm in, with Jenna's more in State College, I'm Williamsport, Wyalusing, some in Wilkes-Barre. A lot of the families that we work with, their home is their largest asset. And so, of course, if we're doing an inheritance tax return and we're figuring out what assets you have, the home's a large asset, several $100,000. But the plan is usually keep the disabled beneficiary in that home where they're comfortable. So we're not talking about cash. I don't care if your house is worth $250,000. If that's where that person, is able to remain and that's where they're going to be most comfortable, we don't think about that as cash, and we shouldn't. So in our life insurance, if you're worried about, if you have a client that's worried about how far their money could go at death, of course, we've got underwriting and all of that to deal with there. But if they're eligible, life insurance is a great way to provide for these people. So, but let's talk about funding. So how do we do it? Well, we talked about life insurance and tax-free. Probably should have changed this slide before I started talking about it, but hey, I had a thought and we're going to roll with it. So estate assets remaining upon your death, and beneficiary designation. So the same way that you can fund anybody's inheritance, you can fund the trust, but it needs to be, I can't stress the importance of titling enough. If anybody's dealt with any large financial companies that you're filling out these forms to, they're very rigid. There's not oh, come on, they forgot to update the beneficiary designations, but this person does have a trust, so can we just put it there? No, you can't. We're looking at at that point, we're looking at a first party trust or something with a payback provision. So that anything that you're going to do upon somebody's death does need to be set up during their life. And this trust can be funded either at death, which is what we've mostly been talking about from an estate planning point of view, but it can be funded during life. As long as it's a standalone trust, there's a trustee in place. It can be opened, money, it can be established, and it can be funded by anybody who wants to give the beneficiary money. One note there I know that the focus here is taxation, but as you've noticed between the three of us, there's always long-term care planning that's on our mind. From a long-term care planning point of view, one of the ways to use this trust during a parent's life is that one of the exceptions to the 5-year look-back period for Medicaid planning is that you are able to gift assets to or for the benefit of a disabled child with no penalty. So let's think of my example of Paul earlier. I said that Paul's an only child. Well, if that parent ever needs long-term care and we're looking at how in the world are we going to pay for that? Well, we could set up a third-party trust, make it irrevocable so that the parents can't get it back out, and add money to that. That way, we've saved the parents' estate for the benefit of Paul. And when the parents go to apply for Medicaid, then the assets that are in that trust are not countable, and they're able to qualify for Medicaid themselves. So while it might seem like I'm kind of bouncing around different topics that we cover, that we do in our office, comprehensive planning kind of touches on all of it. So knowing estate planning, knowing taxes, knowing Medicaid really comes important, because in a plan where it's not just straightforward, everybody's healthy, all of this does flow together. But let's talk about taxes. So how are special needs trusts taxed? Well, we still get the grantor versus non-grantor trust, but a lot of times, especially after the grantor is deceased, these are going to be non-grantor trusts that are taxed as a separate entity. So Julie covered kind of the basis of what these two are, but of course I mentioned earlier that they can be revocable. So if it is a grantor trust, then the income from the trust assets are taxed to the grantor. One of the most common ways you'll see this is if the trust is revocable. A revocable trust is always a grantor trust. So if the parents have the power to revoke it and they're funding it during their lives, the parents will be taxed on the assets. But again, most commonly, you're dealing with a non-grantor trust. So why is this something to be avoided when it can? Well, it's taxed as a separate entity, and we have different tax brackets in there. And so we put the 2023 tax rates on there, and as you can see, these numbers climb very quickly. So over $14,451 of income on that year, that trust is being taxed at 37%, in which, of course, I don't have the individual brackets up here, but individual brackets can get up to 37, but at well over the amount of the 14,000 mark. So be careful about knowing what type of trust it is and making sure that the trustee knows what to do with that money. And to a question earlier, somebody asked about capital gains being taxed to the beneficiary. In a non-grantor trust, the person or entity that receives the income is the one taxed on it. So Jenna talked about accumulation versus conduit trust in the context of IRAs. If it's an accumulation trust and income or RMDs are accumulated in the trust and not distributed to the beneficiary, you're looking at trust tax rates on this chart here. But if it's a conduit trust, or even if it's an accumulation trust, and the trustee is actually giving the money to the beneficiary every year, then the taxation of that income can be put on the individual beneficiary's tax return, which theoretically would be at a much lower rate, especially if they're on SSI. It's very unlikely that you're going to have a beneficiary of a special needs trust in a 37% bracket themselves. So almost always getting that income out is preferable from a tax point of view. But if you're ever advising trustees who are administering these things, sometimes there are considerations that are not purely tax driven that would lead to the recommendation to leave that money in the trust. Because of course, if you've got a large IRA that's doing this lifetime stretch for the beneficiary, if the beneficiary doesn't have expenses that would use all of that income, then you might have an accumulation problem in the beneficiary's name. So, and again, if they're on SSI and they get over $2,000 total assets, they're going to get kicked off benefits. So the trust really isn't doing its job. So sometimes you might have to eat some high taxes for that. But it's all about, knowing your beneficiary, knowing the benefits, and being aware of the circumstances for any distribution. But now the 24% bracket is interesting there. So $10,000, especially if we're talking about an RMD. So I'm advising a trustee right now that's doing a trust for a beneficiary that's in that 27% bracket. So we're intentionally not dumping all of the RMDs to the beneficiary, because if we gave them everything, all of it's going to be taxed at 27%. But if we hold, between 2,901 and 10,550, then we're at 10% for the first 29, 24% for the rest of it. So if you run the numbers on it, we might actually be able to work. It may not be the end of the world to have it there, but again, if we're talking more than $14,000, tax rates are not going to be preferable. All right, so with grantor versus non-grantor, the third-party trust, again, the one that's funded by somebody else, could go either way. Revocable is always grantor, and then, and I mentioned earlier that to avoid estate tax, it could be a non-grantor to avoid estate taxes. And if from a capital gains point of view, a non-grantor trust could use it as part of the beneficiary's estate when they step up in basis for capital gains taxes. So all that being said, and I jumbled that a little bit, but if it's a revocable trust, I talked about parents funding a trust while they're still alive, whether that's for nursing home care planning or just moving the assets along. They can make it revocable, and whether or not they actually want to change anything, that power alone makes it a grantor trust. When they die, it becomes a non-grantor trust. Yes, you have to pay inheritance tax on it, but full step up in basis. So now you've got a non-grantor trust for the benefit of the beneficiary that got a complete step up in basis, whether that's real estate, stocks, other investments, whatever you got in there, full step up in basis. Now you continue the administration for the rest of that beneficiary's life. First party special needs trusts are always grantor trusts because, again, they're being set up by the disabled person for the benefit of themselves. So even though it's not like a regular income only trust that you see in our firm, we'll call them some sort of protector trust where the income is payable to the grantor, this doesn't have any sort of mandatory distributions in it. So there's never going to be a line in the special needs trust that says all income gets paid to the beneficiary. I've seen attorneys try that. Again, it failed, and there's a huge payback to the Social Security Administration beyond that. But the grantor is the beneficiary, and it's theoretically possible for income to be paid to the beneficiary. So even though a first party special needs trust is always irrevocable, income is distributable to the beneficiary, and therefore it's a grantor trust. So go back to Julie's frustration, and I share it too, because these forms for financial institutions were not written by trust attorneys. A first party special needs trust is an irrevocable grantor trust. So when you're filling out a form, how do you do that? Who knows? Honestly, if anybody has advice on how to manipulate these forms to actually give a correct answer, I'd love to hear it. But it's irrevocable. It is grantor because of the income. All right. So I mentioned earlier that in a non-grantor trust, the person or entity that receives the income has it on their taxes. Well, good news on the timeline of all this. There's a 65-day rule, so that way you don't have to rush by the end of the year to get money out of trust to take advantage of individual versus trust tax rate, trust taxes. So the 65-day rule, that's IRS code 663 subsection B, says that within the first 65 days of a taxable year. So if you're looking at a regular calendar year, you've got till beginning of April. If distributions are made from an estate or a trust, then they can be considered as payable in the preceding taxable year. So this I assume is just for the mercy of all tax practitioners. So that way, if you get that rush at the end of year and the trustees are saying, oh no, I think I have to make this distribution, what can I do now? You can push that appointment to January and still get the benefits of claiming that distribution in the previous tax year. And so that's 65 years, and I say within the first 65 days of the taxable year, because of course estates especially work on fiscal years. So fiscal year, calendar year, it all works the same. So let's see an example here. So we got a trust with $30,000 of taxable income, but during that taxable year, only $10,000 was paid out to beneficiaries. And distributions of a special needs trust don't look like cash distributions from a regular estate planning trust. It might be, they're paying expenses because, of course, if the beneficiary gets a bill in their name, paying that bill directly is a distribution to that beneficiary. So in this example, only $10,000 was paid out during the year. That trustee didn't get a chance to meet with their accountant until the beginning of the next year. Under that 65-day rule, let's say, February 2024 is when they had this meeting, they can do another $20,000 of distributions in February 2024 and still claim all of that money was distributed in December or in 2023. So that way, all $30,000 of that income will be taxable to the beneficiary and not to the trust. And for tax practitioners in here, I've got an example of that on the form. So here's an example of the 1041 on page 2, section 6 there. It talks about the is the estate or complex trust making a 663B election. There it is. So if you do have that person that needs to make a distribution in February, there's where you make that election. All right, let's move on to a qualified disability trust. So this is one of those things. It's like a square and a rectangle. A lot of special needs trusts are qualified disability trusts, but not all. To find that distinction, IRS code 642B2C2. And so these types of trusts can qualify for a higher exemption. You got your 2023 number up there, 4,700. In order to qualify, all beneficiaries must be disabled. We're not looking at successor beneficiaries. So, you know, if it's a special needs trust, it should have one beneficiary, and then when that beneficiary dies, it'll pay to, well, you know, whoever the trust says. We don't have to look at that contingent, that second level beneficiary, but all of the primary beneficiaries must be disabled. It must be a non-grantor trust. But as I said earlier, unless it's a first party trust, it's most likely a non-grantor when it's finally gets on tax returns, especially if it's set up by the parent and that parent's deceased. It is going to be a non-grantor trust, so that'll be fine. And then sole benefit for beneficiaries under 65. So again, parent to child, you'll have that up to age 65. But yeah, not all qualify, because again, you know, you've got trusts that can be grantor trusts, like a first party. You can have beneficiaries over 65. But if you have a qualified disability trust, you can take advantage of that exemption. So let's look at a case study here. Parents set up a third-party trust for their disabled child who has SSI and Medicaid. You're normally going to see those two together, because if you qualify for SSI, your health insurance is automatically Medicaid. And this is a hint to look at, you know, when you're figuring out what type of benefit they're receiving, and the parents just say, oh, it's Social Security. Again, well, that's who's cutting the bill, but what is it? If their health insurance is Medicaid, it's probably going to be SSI. If a person is receiving SSDI, or that disability income, that'll trigger Medicare. So that's one way of kind of differentiating. But this example, we got a third-party special needs trust for a SSI Medicaid recipient. Then we got $350,000 in the trust. So the parents, this is probably a life insurance policy or a good inheritance. We got annual income estimated at $22,500. All right, so this chart down here breaks down non-grantor trust versus a qualified disability trust versus having that income, that $22,500 straight on the beneficiary. You can see with the exemption, if you can get that qualified disability trust exemption, $4,200, you can lower your taxable income. But still, even in this example, you can see at the very bottom line there how much taxes would be owed on this. Beneficiaries still has, by being able to use that standard deduction, still has a much lower taxes owed there. So where would you use this as a tax practitioner? Well, I mentioned earlier that under a special needs trust, the language of the trust is not as simple as all net income gets distributed to the beneficiary annually. That's common language for your typical estate planning subtrust. But in a special needs trust, it has all distributions, even income, have to be disability related, not just tax distributions. So there might be a situation where you've paid all expenses for the beneficiary that you can, and now there's this money left in the trust that must be taxed. At that point, you could look at the QDT to have some sort of exemption to at least lower that burden, because while the beneficiaries' taxes in this example are quite a bit better, you still have over $1,000 difference between your typical non-grantor trust rates and your QDT. So keep that in mind anytime you're advising a family that with a child with special needs, or you're doing the trust, you're doing tax returns for a family that has this type of setup. Check that IRS code. I'm actually going to go back there. Yep, 642. Check that to see if you have a qualified disability trust. And if so, when you're doing your 1041, you'll see there on the left side, one of the boxes you can check is a qualified disability trust, and that'll provide the family some help. And maybe you'll be in their good graces come next year. All right, hopefully I've still got everybody. One of the things I'm going to put here at the very end, it's not as much related to tax, but again, as you can tell as I've been talking, it kind of, what we talk about all wraps up together when we're working with a family. So this is not as much on the tax side, but as part of special needs planning, we walk families through what's known as a summary of our wishes. And this is important. This is not even a legal document, so I included this in here. Since this is a tax seminar, I was wrestling with whether or not to even include this. But if we were working with any families with disabilities, any practitioners, this is something that should be on our minds, because we are talking to people about what happens when the parents are no longer there. So we call it summary of our wishes. It can go by any number of names, but a document that lets the parents tell that child's story. It's the idea that nobody knows that child better than their parents. It can be one document that can be passed on that says any the important information. So who's the trustees, guardians, doctors, what medications, pharmacy, health insurance, all of that stuff that whoever's going to take over is going to need. But then personal care and likes and dislikes. So depending on the nature of the disability, this stuff can be very important. So I was at a special needs planning conference one time, and the speaker was talking about this type of document, and they had a situation where a person with a autism diagnosis, before they went to bed, they needed the lights switched on 3 times, 1, 2, 3, or else they would not be able to go to sleep. It would be just upsetting for them. Well, and that type of thing, no one that's not spent an extraordinary amount of time around this person's going to know that. So again, no one knows the child better than their parents. This is a way of memorializing that and putting that into writing so that it could be followed by whomever is going to carry the torch when the parents are no longer there. So the idea is, what we've been talking about this whole time is how to structure that inheritance, how to plan around death or disability from a tax legal side. This is the practical side. At the end of the day, we can talk about protecting assets and tax efficiency and all of that. But at the end of the day, someone's going to be caring for a person with disability. And logistically, anything that you can do to make that transition easier for the caregiver and the person receiving care is going to be better for everybody. So, I think it's just a reminder of when you're talking to these families, of course, they're coming to you to talk about the planning and the taxes and the benefits and all of that. But I always like to slow down and talk about, and make sure that the full picture's looked at, that not only are we going to have the best set up for their estate plan and to preserve their benefits and have talked about tax efficiency, that we ensure that all of this can be done.